In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analyst's predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. I am now going to share with you my successful investing strategy for today's company, which is Ulta Beauty. So stay tuned to find out how to evaluate a business. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. The first pillar we are going to explore is earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. For Ulta Beauty, this is looking flat for the trailing 12 months, as the earnings per share hasn't changed and is 0%. Ideally, we would like to see the growth for each of these metrics increase by 10%. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. And here we can see Ulta Beauty fared less well here, as their free cash flow is down by 10%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Ulta's revenue has increased slightly, as it is 3% for the trailing 12 months. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, their book value has also improved, but just by 3% as well. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are excellent at 30 and 55%. Now we move on to debt. And Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow. Ideally within 3 years, and it would take them just over 2 years to pay off the debt. In this next section, we now focus on other key pillars which help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently a solid 39%, as we would like to see the gross margin over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is 11% and is just below the ideal 14% we would like. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 5.51% this looks perfect. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is 9%, with the lowest point being this year at 3%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is 83%. Later on, when we create a valuation, I will use the lowest of these two average growth numbers to help project our future stock price. In the comments section, I've included a link to the investors page and the annual report, if you want to check it out for yourself. This is Bitesize Investments, giving you a step-by-step approach on your investment journey. Now let's look at past historical performance, to give us a better understanding of the company's successes or failures the business has been through. Looking at the chart, we can see that when the market dipped in 2020, due to the pandemic, Ulta Beauty's share price went as low as $148, but since then steadily kept on rising to about $551. But in 2023 dropped to $371 and then rebounded to go as high as $549 this year. However, Ulta Beauty have recently hit its 52-week low of $338 a share. In addition, we can also see the current market cap is about $16.27 billion. Ulta Beauty is currently generating $11.3 billion in revenue, and their earnings $1.26 billion. At present, their earnings per share tells us that for each share of stock, the company earned $13.32 in profit, which is excellent. And finally, the current P ratio is 13.32, which suggests the company is priced cheaper than the S&P 500, which has a PE of about 27. Now let's have a look at what the analyst's predictions are, which we should only use as a rough guide when reviewing a stock. On average, the analysts believe that the price target should be about $498, but some believe it can go as high as $690. Analyst reports suggest that Ulta Beauty is a little undervalued at the moment. and the overall consensus is they are a buy. Collectively, the analysts believe the company will continue to grow between 1% and 17% over the next few years. Now I am going to show you how to create a valuation. I will use the current earnings per share of 26.03. Now I use a combination of the past growth, future analyst predictions, and the average book value for the past 10 years to create the estimated earnings per share growth. To create a valuation, I'm going to give Ulta Beauty a hopeful 10% growth rate. Then, I am going to give them an estimated PE ratio of 27. After that, I will project these numbers forward by 10 years. We then need to include a 15% return from our investment. This then gives me an estimated future stock price of about $1,823 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $451. Then we apply a margin of safety. At 25% it gives me a buy price of about $338. So, let me just recap. To get a good future return on the company, it would have to grow by 10% and have a PE ratio of 27 over the next 10 years. Realistically, is this going to happen? Possibly, although during economic downturns, luxury goods or services are the first things that people start to cost cut on. But on the other hand, once a person finds a cosmetic range that they love, they will save money on other things before their self-image. If you found this video useful, please consider giving it a like, or click on the link above to check out my last stock analysis, or continue to watch as we are going to look at the possible return, and compare the bull and bear cases. The return we would receive, if we bought at our 25% margin of safety price of $338, and sold in 10 years' time at our estimated future stock price of $1,823, would be 439%. But, this is dependent on our assumptions for the company being correct. In addition, Ulta Beauty don't currently offer a dividend. If you have enjoyed this new video format, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, Ulta Beauty scored 6.5 out of 12. Normally, I would give them a cross. But looking back over the last 10 years, at their past performance against the key pillars, Ulta Beauty consistently score between 10 and 12 stars. So is this year just a blip? Therefore, does it represent a buying opportunity at some discounted prices? Wait until the end of the video to find out if I added Ulta Beauty to my portfolio. As for the past results, their average share price has been going upward until the end of March this year. Their share price has been dropping ever since and has hit a new 52-week low this month. They are currently down by 5% for the last 5 years and 30% year to date. Therefore, I will give them a cross for this. Analysts are signaling Ulta Beauty as a buy, and they are predicting Ulta will grow by just 1% this year. But from 2025 to 2028, they predict Ulta could grow between 10 and 17% over the next few years. Here they gain another tick. Using the EPS growth model I used earlier on, we created a buy price of about $338. Depending on how long this current market correction lasts for, we could see their share price fall lower. But we'll see. Therefore, I will give the valuation a tick. According to Morningstar, Ulta Beauty have a narrow economic moat due to their ability to integrate both the in-store and online experiences together. Ulta boasts one of the largest loyalty programs in the US, with over 42 million members, and is still growing. Over the past 2 decades, Ulta have achieved remarkable financial outcomes. They have compounded revenues at 17% per year, and earnings at 28% per year. Therefore, I will give them a tick for this. My final overall rating is 4 out of 5 stars. To be honest, the 12 key pillars are the essential part of my process. A company must score over at least 7 of them for me to seriously consider the stock. However, based on my analysis, I have decided Ulta Beauty are the exception to the rule. Therefore, I have given this a category A rating within my own stock watch list. And for full disclosure, I have started to create a position in Ulta Beauty, and my average share price is about $343 per share. Lastly, these other checklist items are important and are worth considering before purchasing a stock. The first one is to see if there has been any insider buying or selling of shares. This will give us some behind-the-scenes insight on if they're cashing in on stocks before an earnings call or grabbing more stocks before it takes off. Secondly, make sure you keep up to date with the news for any company you are following, so you can better understand why a stock is trading higher or lower. And lastly, conduct your own research. It is important to create your own rationale and thesis for why you are buying into a company based on your own findings and personal conviction. The book, The Most Important Thing Illuminated, written by Howard Marks, is an excellent read and illustrates the need for rational thought and independent thinking. Click on the link above to listen to the book summary. Thank you for joining me during this stock analysis video.